Let me ask you something uncomfortable. What if the biggest moment in XRP's entire history wasn't a price pump? What if it wasn't a legal win, a partnership announcement, or even an ETF approval? What if the moment that actually changes everything is a Senate vote that most retail investors will scroll past on their feed because it sounds too boring to care about? Here's the thing. Boring is exactly how the biggest wealth transfers in history begin. When the internet got its first commercial regulations in the mid-90s, nobody threw a party. Nobody made a YouTube video about it, but the companies that understood what those rules unlocked. They became Amazon, they became Google, they became the architecture of the modern world. Right now, something eerily similar is unfolding in Washington, and XRP is sitting at the center of it. Not because of hype, because of plumbing. Stay with me, because by the end of this video you're going to see this moment completely differently. So here's what's actually happening. There's a piece of legislation moving through the US Senate called the Digital Asset Market Clarity Act. And what makes this different from every other crypto bill we've seen over the last decade is surprisingly simple. This one actually has teeth. Previous crypto regulation conversations in Washington felt like adults arguing about whether the internet was a fad. They were reactive, confused, driven by fear more than understanding. But this bill? This is proactive. This is legislators finally sitting down and asking a foundational question. What box does a digital asset go in? And who has authority over that box? That might sound like a bureaucratic headache, but for anyone who understands how institutional money moves, that question is everything. Think about it this way. Imagine you're the chief investment officer of a major pension fund. You're managing the retirement savings of hundreds of thousands of teachers, firefighters, nurses. You have a fiduciary duty, a legal obligation to protect that capital. Someone walks into your office and says, "Hey, you should put 2% into digital assets." Your first question isn't which coin? Your first question is this legal? Am I protected? What regulator oversees this? If something goes wrong, who do I call? And right now today you cannot answer those questions cleanly in the United States. That's the problem the Clarity Act is trying to solve. Not for retail, not for traders, for the suits, for the people who move money in the hundreds of billions. And that is exactly why this matters for XRP in a way that goes far deeper than a price spike. Here's the perspective I don't think enough people are talking about. XRP isn't just a token waiting for regulatory approval to moon. XRP, and more specifically, the XRP ledger, is being quietly built into something that looks a lot like financial infrastructure. And infrastructure doesn't pump. Infrastructure persists. Let me give you an analogy. When SWIFT was created in 1973 to standardize international bank messaging, nobody bought SWIFT coins. Nobody charted the price of SWIFT on a weekend. But today, SWIFT processes the backbone of trillions of dollars in cross-border transactions every single year. It became invisible, and that invisibility is the proof of how deeply embedded it became. Now, I'm not saying XRP becomes the next SWIFT. But I am saying that the XRP ledger is being engineered to compete for the same job: cross-border settlement, liquidity provisioning, tokenized asset movement at a fraction of the time and cost. And here's the critical insight. Infrastructure needs rules before it can be trusted at scale. You wouldn't let a construction company build the foundations of a city if they didn't have building codes, liability frameworks, and inspections. The same logic applies here. Before a major bank or payment processor stakes their reputation and their balance sheet on blockchain rails, they need a regulatory framework that tells them what's allowed, what's protected, and what oversight looks like. The Clarity Act is that framework, or at least it's the beginning of it, and Ripple the company behind. XRP has spent years building toward this exact moment. The legal battles, the institutional partnerships, the ledger upgrades, none of it was random. It was sequential. It was deliberate, like laying rails before the train arrives. Now I have to be honest with you about something, because this story isn't without friction. The banking sector hasn't exactly rolled out the welcome mat for this legislation. And their concerns are worth understanding, not because they're right, but because they reveal exactly what's at stake. Banks have spent decades building correspondent banking networks. These are the relationships between financial institutions that allow international money movement to function. It's slow, it's expensive, it involves a chain of intermediary banks, each taking a cut, each adding days to a transaction, and it is enormously profitable for the institutions at the center of it. Now imagine a world where a company in Argentina can pay a supplier in Japan in seconds on a decentralized ledger with near zero fees and full settlement finality. The correspondent banking network becomes optional. That's not a small threat, that's an existential one. So when banks push back on stablecoin yields or raise concerns about consumer protection clauses in this bill, you have to read between the lines. Some of it is legitimate regulatory concern, but some of it, and I'd argue a significant portion, is industry incumbents trying to shape the rules before the rules reshape them. This is normal. This is how every major technology transition has worked throughout history. The railroad companies lobbied against cars. The cable companies lobbied against streaming. The battle isn't new. Only the asset class is. But here's the thing about lobbying. It can slow legislation. It can water it down. What it cannot do ultimately is stop a technology that makes the existing system genuinely obsolete, because the market finds the efficiency even if the rules lag behind. So let's get specific, because I know what you're thinking. Why XRP and not Ethereum? Why not Solana? Why not any number of other blockchains that also want a piece of institutional finance? Fair question. Here's my honest take. XRP's primary design purpose has always been settlement speed and liquidity bridging. That's not a pivot. That's not a rebrand. That's what the technology was architected to do from day one. When a bank in one country needs to send value to a bank in another country, the friction is almost always in the middle, the lack of a shared, liquid, instantly accessible bridge. XRP was built to be that bridge. Compare that to Ethereum, which was designed as a programmable smart contract platform, genuinely revolutionary, but not optimized for payment settlement in the way XRP is. Or Bitcoin, which is increasingly viewed as a store of value rather than a transaction medium. XRP sits in a very specific lane, and increasingly that lane is exactly where institutional interest is converging. The ledger upgrades happening right now, including new lending protocols and asset vaulting mechanisms, aren't cosmetic improvements. They're the financial plumbing being installed before the water gets turned on. Institutions don't invest in the water, they invest in the pipes. And when regulation finally confirms that these pipes are legal, compliant, and supervised, the capital that's been waiting on the sidelines, patient, cautious, enormous, starts to flow. Zoom out for a second, because this is really about something much larger than XRP. We are living through the earliest innings of a complete restructuring of how money moves on planet Earth. The current system, built on post-World War II institutions, 1970 seconds messaging protocols, and 20th century correspondent banking, is straining under the weight of a 21st century digital economy. Emerging markets are being crushed by remittance fees. Small businesses are waiting days for cross-border payments. Settlement risk is baked into every international transaction because the infrastructure is fragmented and slow. Digital assets, if properly regulated, don't just improve this system, they replace it. And the country that writes the rules for this replacement clearly, confidently, first gets to shape the next century of global finance. That's what's being decided in Washington right now. Not just for XRP, not just for crypto, for the architecture of money itself. The Clarity Act isn't a crypto bill, it's a monetary sovereignty bill dressed in technical language. And XRP, with its unique positioning, its legal history, and its infrastructure build-out, may be one of the best positioned assets to operate within whatever framework emerges. Now, I'm not going to sit here and tell you this is guaranteed, because it's not. Legislation can stall, it can get amended beyond recognition. Political winds shift. A bill that looks close can get tabled for 6 months because something else hijacks the Senate calendar. And even if the Clarity Act passes in a strong form, that's the beginning of institutional adoption, not the completion of it. Institutions move slowly, deliberately, and with enormous due diligence. We're talking about a multi-year onboarding process, not a week-long rally. So if you're watching this expecting May to be the month XRP flips your portfolio, you're probably thinking about this the wrong way. But if you're someone who's looking at the trajectory, the legal clarity that's already been established, the infrastructure being built, the regulatory framework converging, the institutional interest warming, and you're asking yourself whether this is an early-stage entry point into something genuinely structural, that's a very different question, and it's one worth taking seriously. Here's what I want you to walk away with. The most transformative moments in financial history almost never feel exciting when they happen. The creation of the Federal Reserve, the Bretton Woods Agreement, the deregulation of interest rates in the 1980s. None of these made headlines the way a market crash does, but they shaped everything that came after. A Senate committee vote on a digital asset clarity bill might feel like another forgettable news cycle. But for anyone paying close attention to what's actually being built, the ledger upgrades, the institutional partnerships, the regulatory positioning, it looks a lot less like noise and a lot more like signal. The question worth sitting with is this: when the infrastructure is finally trusted, when the rules are finally written, and when the capital finally moves, will you understand why it moved? Or will you just be surprised by the number on your screen? Drop your thoughts in the comments. I want to know, do you think this legislation passes this cycle, or does Washington kick the can again? And more importantly, do you think XRP's infrastructure story is being undervalued by the broader market right now? No financial advice here, just a deeper look at what's actually being built. If you found this valuable, hit the like button and subscribe. I'll catch you in the next one.